If you've been trading stocks for a while and want to start trading options but don't know where to start, stay here and in less than 9 minutes, you'll learn options basics and see options in action so you can start trading them right away. Options are classified as derivative products because their value is derived from the price of a different instrument called the underlying. They can usually be traded through the same broker you trade stocks on, so it's relatively simple to start trading them. There are two types of options, calls and puts. Calls give their buyer the right to buy 100 shares of the underlying instrument, in this case a stock, at a predefined price called the strike price, on or before the expiration date. Puts give their buyer the right to sell 100 shares of the underlying instrument at a predefined price called the strike price on or before their expiration date. With this, we can see that an option is completely defined by the following parameters. Option type, whether it's a call or a put, the underlying instrument, in this case the stock that this option will be used with, the strike price, which is the price that a call owner has the right to buy at and a put owner has the right to sell at, and the expiration date, which is the last day of the period that the option will be valid for. Graphically, if we want to see how options work, we can start by analyzing a call on a specific stock. For a certain expiration date and strike price, this call will be trading at a certain price, also called option premium, which is the price of the call in the options market. Likewise, a put on the same stock with the same expiration date and with a specific strike price will also be trading at a price that this put can be bought and sold at in the options market. If the price of the stock goes higher beyond the strike price of the call, the prices of the call and put will change accordingly, with the call premium being higher in price since the call gives its owner the right to buy 100 shares at a price that's lower than the current stock price. This will represent a profit for the call owner that can be materialized by exercising the call, which means buying 100 shares at the strike price and then potentially selling them at the market price for that stock, keeping the difference between strike price and market price as profit. However, most option traders prefer to sell the call directly in the market to realize that profit in a simpler way. Notice how the put premium went down, since it makes more sense to sell stock at the market price than to sell at that put strike price. If, however, the stock price were to go lower, then we'd see the put premium go higher and the call premium go lower, since the put gives its owner the right to sell at the strike price, which is higher than the current stock price. This will represent a profit for the put owner, which can be realized by buying the stock at its current price and exercising the put to sell at a higher price, keeping the difference as profit. However, much like in the case of call profits, most traders prefer to sell the now more expensive put in the options market directly to realize the profit on that put. Microsoft is currently trading at a price of $212 per share. Instead of buying or selling stock short, we'll use options to speculate on Microsoft's stock price going forward. We'll use options with 44 days to expiration, which means that these options can be exercised or traded for the next 44 days, at which point they'll expire. To speculate on Microsoft's price going higher and putting on a bullish trade to profit from it, we'll buy one call option contract with a strike price of $230. This call is currently trading at $3.60, so we pay $360 for the 100 shares covered by one call option contract. If the price of Microsoft goes to $250 on or prior to expiration, the price of the 230 call in the options market will be at least the difference between the current stock price and the strike price of the call, so it'll be trading for around $21 per contract after the move, giving our position a total value of $2,100, $1,740 higher than our original cost of $360. If we compare bullish positions, buying 100 shares for this price move would have had our position going from $21,200 to $25,000, whereas buying one call option contract would have turned our $360 investment into a $2,100 position. This represents an 18% profit for the stock position and a 483% profit for our options position. In addition to this, buying 100 shares of Microsoft would have represented a potential maximum loss of our whole investment of $21,200, with the stock position losing the same percentage as a potential drop in the stock dollar for dollar. Whereas with the call, even in the unlikely scenario of the stock going to zero, we can only lose the initial cost of that call, or a total of $360. Now, if our outlook for Microsoft is negative, we can establish a bearish position by buying, for example, a put with a $190 strike price. The initial cost of this position is $2.60 per contract, or a total of $260. If the price of Microsoft drops to $170 on or prior to expiration, the price of the 190 put in the options market will be at least the difference between the put strike price and the current stock price, so it'll be trading for around $21 per contract after the move, giving our position a total value of $2,100, $1,840 higher than our original cost of $260. As it was the case with calls, selling 100 shares short will profit in the same proportion to the percentage of the price move, whereas buying a put leverage our capital to provide much greater profit percentage when compared to a straight short sell. In this case, 20% with stocks sold short and 708% in the case of the put. Also, similar to calls, buying puts has a maximum loss that is limited to the cost of the put as opposed to the potentially unlimited max loss in the case of selling stock short. One of the main advantages of adding options to your existing stock trading is the fact that stocks, calls, and puts can be combined into strategies that can be tailored specifically to your needs and outlook for future market action. Options are powerful, yet simple and accessible financial instruments that give you advantages and practical uses for them that no other product can provide. Among them, we've already explored leverage, allowing you to use your capital more efficiently in the markets, for example by buying calls or puts. You can also use them for protection of existing assets or positions, in some cases at no cost to you, such as in the case of costless collars, or ensuring a minimum value for your holdings through a protective merit put. Finally, perhaps the most powerful use of them all is as instruments providing strategic flexibility, allowing you, for example, to generate an income stream from existing positions in a cover call, or to profit when a stock stays inside a price range with an iron condor, among many other possibilities. Options expand your possibilities when it comes to your own investment and trading decisions, so if you choose to make options a part of your financial portfolio, you'll be in a much better position, ready to take advantage of the opportunities the markets consistently provide.